Well, good afternoon, everybody. Theme of Martin and my paper is nicely summarized by a quote from Thomas Sewell. He says, "It's hard to imagine a more stupid or dangerous way of making decisions than by putting those in the hands of people who pay no price for being wrong." And I think it's as simple as that. And I think the history of the Federal Reserve provides a perfect example of this elementary truth. Now, once upon a time, the United States had a simple system that regulated itself. When a crisis occurred, it would be dealt with by industry leaders. These provided emergency loans and in some cases issued emergency currency. The most famous example was 1907, orchestrated by J.P. Morgan from his library. The only role played by the government in this deal was to agree not to undermine the solution of the crisis by promising not to invoke the Sherman Act, because essentially the centerpiece was the acquisition by US Steel of Tennessee Coal and Iron, which was in violation of the Sherman Act. So the president helpfully agreed not to get in the way, and the problem was solved. Now, of course, there was no Fed. Underlying this system was a conventional wisdom that was much more laissez-faire than today, and associated with this, and I think this is very important, were high levels of personal liability and personal responsibility, and these created strong incentives to keep costs down and to control risk-taking. There was also little formal regulation. Those involved understood that bad regulations were costly and that they themselves would bear the cost. Participants also operated against the backdrop of the discipline of the gold standard. This served to ensure that interest rates and the cost of credit were largely beyond the control of individual institutions and in line with market fundamentals. So all in all, there was a tightly governed, self-managing system with lots of reinforcing checks. Then the Federal Reserve came along, and one by one, the props that controlled excess were kicked away. So let's begin with monetary policy. How is the Fed's record? Well, not very good. I mean, let's take as read the catastrophe of the 30s and the inflationary excesses of the 50s onwards, both due in large part to Fed mismanagement. A recurring theme is the boom-bust cycle, itself a product of Fed policy. We had the low interest rate policies of the 1920s and associated boom and bust. We saw much the same in the late 60s and the bust of 1970. Again, in the late 80s, when Alan Greenspan introduced his famous put in the aftermath of October 87. This was followed by further easing in 91. By the mid-90s, Mr. Greenspan was complaining of irrational exuberance. He responded not by raising, but by reducing interest rates, stimulating the tech boom, which went bust in 01. He responded to that by a more aggressive monetary policy. This produced an even bigger boom that culminated in 08, 09. His successor then responded with an even more aggressive monetary policy, in the process stimulating the biggest bubbles of all time and leaving policymakers with a huge headache, or hangover, should I say. We get an ever more damaging boom-bust cycle, and the state of affairs described by British central banker Andy Haldane. Now, speaking to the Treasury Select Committee in June, Haldane said that the biggest risk to global financial stability right now is that posed by inflated government bond markets. He then told astonished MPs, "Let's be clear, we have intentionally blown the biggest government bond bubble in history." So basically, there's a central banker has admitted it. They have intentionally created the biggest threat to financial stability that we face. So basically, all those critics of the Fed may as well give up and go home. Now, the same could be said for the Federal Reserve. The financial system wouldn't be so unstable if the Fed hadn't tried so hard to stabilize it. I think we know that the latest bubbles must burst, and when they do, interest rates will rise. When that happens, the financial system will collapse again. The temptation will then be to prop up bond markets by monetizing what could well be the entire government debt. Inflation will then be off to the races. Now, central bank officials have no credible solutions to the problems that they have created. Instead, they offer lame excuses and ask us to trust them again as they try to gamble their way out. In these circumstances, it's not surprising that policy discussions are increasingly dominated by cult of personality nonsense. The genius of Ben Bernanke or whoever, as if these people had some magic wand that would make our problems go away. Of course, they won't. Now, let me get to the bad news. Unfortunately, it's not just monetary policy that's the problem. There's the lender of last resort function. Now, in the old days, this was provided by the market itself, and it worked. Then the central bank took it over, and it all got horribly out of control. Now, we have a very weird policy logic here. We rule out the best solution, which is free banking. This is mistake number one. We then offer bankers help instead of punishment when they get into difficulties. This is mistake number two. The sign is wrong. Instead, we don't just help them, we bail them out and never mind all those earlier promises that next time we really are going to let badly run banks fail. Instead, the bankers see those threats as what they are, which is hot air, and we find ourselves with the albatross of too big to fail stuck around our necks and a huge incentive to take irresponsible risks. So if we ever want to put this particular genie back in its bottle, bankers who get into difficulties need to face personal punishment. Now, of course, critics might argue that they would never then apply for assistance. We would argue this is exactly the point. We don't want them to. Then there's the federal deposit insurance. This was established in 1934 to stabilize the banking system by removing the incentive of depositors to run. It was bitterly opposed by the bankers of the time. The president of the ABA called it unsound, unscientific, and dangerous, and he was right. Deposit insurance was bad because it creates major moral hazards, incentivizes banks to take risks, to run down their capital. And critics also pointed out that when it was tried at the state level, it didn't work. A good example was Texas in the 1920s. To quote one observer, the plan made too many banks and too few bankers. All kinds of incapable people tried to start a bank under the protection of the fund. The system gave a false sense of security. People looked to the fund for protection and paid no attention to the soundness of the banks. Such an unsound system weakened the financial structure of the entire state. As Richard Salzman nicely put it, federal deposit insurance was instituted under political expediency, despite prescient warnings and frequent references to the most basic of economics. The eventual outcome was the crisis of the 80s and early 90s and the destruction of much of the American thrift industry. Then there's financial regulation. Well, I think the most basic metric of financial regulation is its length. The Federal Reserve Act ran to 32 pages, so I believe. Glass-Steagall was 37 pages. Dodd-Frank is 848 pages long. But this gets much worse. The scope and structure of Dodd-Frank are very different from earlier laws. In essence, all this 848 pages is merely an outline that instructs bureaucrats to make even more regulations and create even more bureaucracies. So experts have suggested that the eventual Dodd-Frank rulebook might run to maybe 30,000 pages. But personally, we feel that's rather optimistic. When they hit that, they'll just carry on producing more rules. Then there is the huge and growing cost of financial regulation. So we see the SEC budget up 91% since 2007, CFTC budget up 407% since 2007, OCC up 69%, CFPB a cool $500 million, and this didn't even exist a couple of years ago. Then, of course, there's Basel, and then there's the Fed. And these are only some of the direct costs of regulation. You've got all the costs of compliance. And then you've got the indirect costs of regulation, things like the damage they do, the cost of poorly designed rules, of crises bungled by regulators, and so on. Then you have all the poorly designed rules, and John has spoken very eloquently about these. I'll merely say that what is worse than poorly designed rules are poorly designed gameable rules. these encourage the looting of bank capital and secret offloading of risks onto other parties with serious systemic implications. So some of my favourites are capital plundering or how to destroy securitizations. These leave banks seriously capital depleted, even though their risk-adjusted numbers are better. Then we have SPV alchemy. You take a portfolio of junk, turn it into AAA, flog it off using a special purpose vehicle, and watch the fun when the alchemy goes into reverse. Then you have hidden hypothecations, in which banks furtively pledge assets to counterparties while the assets remain, they furtively pledge assets to other parties while the assets remain on the balance sheets to deceive future counterparties, which is fraud. Then you have hidden rehypothecations, in which there is the typically secret reposting of collateral that has been posted with financial institutions. Many investors think that when they make a collateral or whatever deposit, it's just put in a vault and it's safe. But this is not how it works. Now, this problem, the fact is that a lot of these collaterals are reposted a dozen times, 20 times or more. And this came apparent with the MF Global meltdown in 2001. And this showed how client funds were being shifted around and then lost in a massive Wall Street manipulation of brokerage rules. Now, to be fair to Wall Street, they were exploiting flaws in British rules that left American investors exposed. So you can't blame it all on the Fed. But the numbers involved in this daisy chain are staggering. CIBC, $72 billion. RBC, 54 billion, Credit Suisse, 332 billion Swiss francs, JP Morgan, $410 billion, Morgan Stanley, over $500 billion. If anyone thought that you couldn't have your cake and eat it too, MF Global shows that you can have your cake, eat it, eat someone else's cake, and then let your clients pick up the bill and stay out of jail. Then you've got regulatory capture. So you have capture by the industry who game the rules, capture by the regulators who push for more power and resources. The Volcker rule is a perfect example. This had the worthy intention of banning proprietary trading by institutions on government support, and so stop one avenue by which traders could speculate for gain at the expense of the taxpayer. Now, threatened with the loss of one of its favourite lunch buckets, the industry responded by lobbying for more exemptions, and in so doing, they bloated it into a 530-page monstrosity, killing it by filling it full of holes. They then moaned afterwards that it was too long and complex to implement. They'd certainly seen to that. And remember that Volcker's original idea was for a simple rule that left no exemptions and no ambiguity. You've got to understand that regulatory capture is also the reason why so many bad rules exist on the book, despite their weaknesses being well known. They exist because they serve the interests of key groups. John mentioned, for example, the endorsement of the Gaussianity assumption and the useless value at risk measure. These are useful to the banks because they lead to major underestimates of risk exposures and hence low capital charges. Capital can then be siphoned off and senior management can play dumb when the bank collapses. Another example is Basel II. Now, Basel II is just thousands of pages of gibberish. It was rolled out in 2004 after a decade-long effort to put it together. Then the crisis hit and the banking system crashed. In the panic, regulators then rushed out many thousands of pages of new draft rules, many more thousands of discussion papers and consultation documents. And so great was the regulatory material, the deluge of regulatory material, that by spring 2010, observers were joking that this was tantamount to a Basel III. By the fall of that year, Basel III had become a reality. So the joke was on the jokers. But I would suggest that the real jokers are those who tell us that the solution to all that gobbledygook is to have even more of it, crafted on the fly by the same people who'd gotten it wrong before, not to mention the times before that. Now, this reminds us that modern financial regulatory systems are not only prone to failure, but they thrive on it. In any sensible system, failure would lead to some error correction. This is what the market does. In practice, this always gets hijacked into let's have more regulation. So when it fails, the response is not let's get rid of all that useless regulation, but let's create a system that works. That's what we want. That then gets hijacked into let's have more regulation. In this game, nothing succeeds like failure. There's also the problem that there's no mechanism to make rules or policies consistent. Again, John has spoken very eloquently on this. Consistency becomes impossible. And faced with rules that clash or laws that clash, those who arbitrate, the policymakers, the regulators, can choose which laws or rules to apply and which to ignore. Whatever the problem, they can point to some rule that addresses it, and never mind the fact that it's contradicted by something somewhere else. They can then argue with the appearance of plausibility that their regulatory systems address any and all problems. And then we have the appearance of rules, but the reality of unaccountable discretion on the part of those managing the system, whether it's monetary policymakers or financial regulators. And there's no mechanism to hold them to account. So basically, they couldn't have come up with a system that was less fit for purpose, even if they'd set out to do so. And bang goes the rule of law, and we end up with a regulatory dictatorship. We've gone from a system that managed itself to one that requires management, but cannot actually be managed. And so the outstanding question is simple. How do we get back from here to there? And preferably before the system collapses. Now, obviously, at rollout, John's already said this, and other speakers the same, get rid of the Fed, get rid of deposit insurance, get rid of all that useless financial regulation. I would add restore extended liability for bankers, certainly get out of Basel and all that, Dodd-Frank, the whole lot, get rid of it, and restore the gold standard or some similar sane monetary regime. But to end on a not too helpful note, I mean, one can't resist the temptation for bad taste. This reminds me, the situation we're in reminds me of the punchline of a classic Irish joke. I wouldn't start from here if I were you. So thank you.